Imagine waking up to find that the second largest foreign holder of US debt is quietly cashing out. Not just a few billion, but hundreds. That's exactly what's happening right now. China is accelerating its sell-off of US Treasury bonds. And it's not just an economic signal, it's a political message. This could reshape global markets, rattle the US economy, and put Trump's trade war strategy under the spotlight. The question is, can the US stock market really absorb the shock? Let's break down what's happening, why it matters, and what it means for your money, investments, and the future of US-China relations. In recent months, China has significantly trimmed its US Treasury holdings, bringing them down to around $650 billion, the lowest in nearly 15 years. Compare that to more than $1.3 trillion in 2013 and $860 billion just 2 years ago, and you start to get the picture. This isn't just routine economic diversification, it's a strategic maneuver. One that's likely been triggered by renewed tensions caused by Trump's aggressive trade agenda. Since late 2024, Donald Trump has pushed to reinstate and expand tariffs on Chinese goods, especially in high-growth sectors like electric vehicles, semiconductors, and renewable energy. The policy is pitched as a protective shield for American industries, a way to bring jobs back home and reduce dependence on Chinese supply chains. But Beijing has responded in kind, and this time, with more than just retaliatory tariffs. Dumping US debt is a powerful move because treasuries are one of the cornerstones of global finance. When countries like China buy treasuries, they're essentially funding US government operations, and doing so at low interest rates. But when they sell, bond prices fall, and yields rise, and that's exactly what's been happening. The 10-year Treasury yield recently climbed above 4.7%, marking the highest level since the financial crisis in 2007. That spike matters. Higher yields mean the US has to pay more to borrow money. It affects everything from mortgage rates and corporate debt to government spending. The cost of servicing the national debt, which now stands at over $34.5 trillion, is rising fast. Now let's talk about how this is playing out in the stock market. As yields rise, the equity markets start to feel the pain. In just a few weeks, the S&P 500 dropped over 5%, and tech-heavy indexes like the Nasdaq fell even more sharply. Companies with heavy China exposure, like Apple, Intel, and Tesla, saw billions erased from their market caps almost overnight. Investors are spooked. They're asking, is this a temporary shakeup or the start of a broader financial shift? Beyond Wall Street, this is sparking a deeper conversation among economists and policymakers. Because what we're witnessing is not just a bond sell-off, it's a signal of a shifting global order. China isn't just offloading treasuries, it's actively working to promote the yuan in global trade and reducing its reliance on the US dollar. It's deepening financial ties with countries in BRICS, Brazil, Russia, India, South Africa, and negotiating energy deals in currencies other than the dollar. This move is part of a broader strategy of de-dollarization, and while the dollar remains the dominant global reserve currency, cracks are beginning to show. The share of global reserves held in US dollars has dropped below 59%, down from 70% in the early 2000s. China's bond sell-off is accelerating that trend, not overnight but steadily, and with a long-term vision. Now let's zoom in on the US economy. Can it handle this pressure? It's complicated. On one hand, the economy remains resilient. Unemployment is low, consumer spending is steady, and corporate earnings haven't collapsed. On the other hand, inflation remains sticky, still hovering around 3.6%, above the Fed's 2% target, and interest rates are already elevated. The Federal Reserve is caught in a bind. Cutting rates too soon could reignite inflation, but keeping them high could deepen financial instability, especially if foreign buyers continue dumping US debt. And what about Trump's tariffs themselves? The goal was to reduce the trade deficit and protect American industries. But so far, early data for 2025 shows the opposite. The US trade deficit with China widened to over $97 billion in the first quarter, as American demand remained strong and tariffs only raised prices, not reduced imports. In fact, some economists argue that tariffs are now a double-edged sword. They may protect certain domestic industries in the short term, but they also increase costs for US manufacturers, limit global competitiveness, and, as we're seeing, provoke retaliation that hits our financial markets at their core. Investors are adjusting their strategies. Gold has surged past $2,300 an ounce, and Bitcoin, which had slipped earlier this year, is now back above $58,000, as people look for hedges against both inflation and geopolitical instability. Oil prices are also rising, with Brent crude approaching $94 per barrel, driven in part by fears of supply disruptions and global market uncertainty. So where does this all leave us? At the center of this storm is a question of leverage. Who really holds the upper hand? The United States with its economic size and financial institutions, or China with its vast reserves, global ambitions, and willingness to play the long game? One thing is clear, this isn't just about tariffs anymore, it's a battle over financial dominance, over who controls the levers of global capital. And as China offloads treasuries and the United States scrambles to manage higher debt costs and a volatile stock market, we're starting to see how fragile that balance really is. Whether you're an investor, policymaker, or just someone trying to understand where the world is headed, this moment matters. Because if these trends continue, we could be entering a new era of global finance. One where the dollar isn't quite as dominant, where debt costs more, and where trade policy doesn't just affect factories, it affects the future of the financial system itself. So keep your eyes on the bond markets, the Fed's next move, and China's next financial step. Because this story, it's just getting started.